something that you don't think about normally when you're talking about what your parents taught you or what this kind of standard financial advice is. So today we're going to cover a piece of that puzzle that's a little bit different than what you might have been used to. These are things that financial advisors will know about, but they may not know about specific parts, and those are funds. So a little bit, for those that might be new to the tribe or might not know exactly who I am Andrew Chestnut. I am the educational engineer here at Money School. So if you see any of the presentations that Chris does, if you see any of the case studies we do, I'm the one that takes all of that high-level data that Chris has and boils it down so that people can understand it. So that's my mainly what I do here. So I tend to be also the numbers nerd. So if they come across a policy design and say, hey, would this going to work for IBC? Let's take a look at this. What's the long-term performance on these policies? How do the numbers work? I'm the guy that really digs into those numbers, gets way, 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 way in the meat weeds with numbers and really takes a look at them. So I'm also heading up what is called the Money Mover team. So what the Money Mover team does, we're here to educate you how to make your money move. Sounds pretty straightforward, right? So think about this. So we have self-directed IRAs, something that most people have not heard of. So with self-directed IRAs, what do you do? The great part about a self-directed IRA is you have complete control over your money. The worst part about a self-directed IRA is you have complete control over your money now. So you now have to make decisions, and you have to make your own investment decisions and so finding investment advice can be somewhat difficult. So that's what we created the Money Mover team for. So that's the other side of it as well. So that's also what I head up. But that's one of my passions in life, though, is teaching people what you haven't been taught when you were young. See, with all of the best of intentions, your parents probably taught you to put money away into a savings account, put money away into a retirement account, save everything up, do things a specific way. The problem is there's other ways to do things. And for those of us who may be entrepreneurs and might think differently than what our parents did, doesn't mean your parents were wrong. Parents probably did well for themselves. But for those of us that think differently, the education that we give here at the Money School is that different way of thinking of things. See, there's two different sides to things. There's spenders and savers. I'm writing a course on this right now, and it's just something that's in the top of my head, and I wanted to explain this to folks. You have savers. Your parents were probably savers. What savers do is they put a little bit of money aside, keep putting a little bit of money aside, and as soon as they have enough, they buy something. Okay, so that's a saver. And a lot of people we know are savers because with a W-2 job, with a standard 9 to 5, that's what you do. You put a little bit aside and you wait until you buy, you wait until you have enough money for a down payment for a house. You wait until you have enough money for a down payment for a car. You wait until you have enough money to buy a new computer, things like that. Spenders are a little bit different. And this is where the mindset change happens, at least what we do at Money School. Spenders are, how can I make more money to create the lifestyle that I want? So a really good example is I have a friend of mine that keeps calling it lifestyle by design. I take a nap at 2 o'clock in the afternoon. He kind of does what he wants. He took off to Costa Rica for 2 months because he wanted to go to a coaching course down there. He has a lifestyle by design. He said, how much income do I have to make? And how do I make that money in order to be able to have that lifestyle? And it sounds wonderful, but there's a lot of work that goes into it. There's a lot of excess knowledge that happens. And it's just something that kind of you think about, something that you don't think about normally when you're talking about what your parents taught you or what this kind of standard financial advice is. So today we're going to cover a piece of that puzzle that's a little bit different than what you might have been used to. These are things that financial advisors will know about, but they may not know about specific parts, and those are funds. So we've had a few funds here with Money School. We've had a few funds on the Private Money Club that are available. We've got one that's open right now with Duck Vaughn. I will go over that in a little bit as well to let you know that opportunity. I have one as well that I'm going to present to you too. But funds are a little bit different. So the first thing I want to cover with you before we get into funds, I want to show you very high level how to structure a portfolio. Okay, so we always talk about the all-weather portfolio. What this is not, every person is going to be doing things differently. This is based off of something that Ray Dalio said, so your mileage may vary. This may be something specific to you. You may be able to use this, you may not. This isn't, if you're depending on what your end goal is, depending on what you want to do. If you're 55 and right about ready to go to retirement and you have about $300,000 in the bank, this is not going to be the best thing for you. Everyone's going to be a little bit different. But I always like to put this up and just show that no matter what happens, stock market going up, stock market going down, housing market super hot, housing market is flat, whatever's going on, this is a good conservative all around, no matter what else is going on in the world, this will generally perform decently. So Ray Dalio came up with it. And if you look at this, only 5% are stocks and equities, 10% precious metals, but most of what you have here are long-term treasuries and IBC, cash, and private banking. It's the majority of what this is. What they're doing is they're setting up a good, solid foundation. And then we get into fun stuff like alternative investments and crypto. We get into precious metals, other things as well. But we get the solid foundation on your house that is your investment strategy. And one of the things as well that we probably should put in here, because it's something that we offer, are funds. Now, funds are interesting. You put money in. So if you want to invest in real estate, let's say, but you don't want to deal with tenants, termites, or toilets. You don't want to deal with any of that stuff. Funds are a way to go. What you do with a fund, and there's a few different types of funds. So I'm using this as sort of a generalized concept of things, okay? So with a fund, you put your money in, and we give you a certain amount as a percentage rate, an interest rate. So it's set it and forget it money, mailbox money, however often the fund pays interest. I think some of ours pay monthly. You just get your monthly check every month, and that's it. So if you want to really get a good solid foundation, long-term treasuries do the same thing. You put your money in, they give you a certain percentage back again. Using these as a foundation for your investment strategy, and then going and doing the cool stuff like, okay, so I want, let's say, 50% of my income or 50% of my retirement to be in a fund. Okay, there's my base level, that's my foundation. And then, I'm going to do an extra 15% of that. That's going to be in crypto, but you still have that base level. So if something goes wrong with the crypto, because it's a speculative investment, you now have something there. So have a good base for it. So that's definitely something that is, these are just good ways to get mailbox money with no tenants, no termites. So just as we go along, folks, I am monitoring the chat. Most of the time I can see questions in the chat, but if you do me a favor and put them into the Q&A, if you have any questions, and that way, then I am 100% sure to see it. Sometimes if the chat gets going, we have some, I may or may not see it. So just to request that. So now let's talk about the funds that we're talking about here. Now I did have a PowerPoint for this. Unfortunately, PowerPoint lost it on me right before I was about to come on. So I'm just going to have to talk through this. Sorry for no visuals. I'll draw on the board if we need it, but I want to go through what these funds are and some of the stipulations, and you'll hear a bunch of words for it. Syndications are a type of this type of fund. They fall under section 506 B and C of securities regulations. Okay. SEC registered. So SEC registered is, they're not overseen by the SEC. The SEC knows about them. The SEC has some very high level kind of things that they require. We'll get into what that is in a moment here, but they're overseen by the SEC, but they're not, we don't have banking regulations. We don't have a bunch of other things like that. So 506B funds, they're also called Reg D funds. These funds are, we can't publicly talk about them unless you're a partner in the fund. So that's what most of the funds that we have, you have to be a partner in the fund to be able to give details about it, to be able to sell them, because we don't have to be licensed we don't have to be licensed to sell these things. These are more just, let's get a group of friends together, pool your money and invest in something. So the funds that we have available right now they pay a certain amount every year, or every month, or however often they're paying interest. You put your money in for X amount of time, so there's a certain chunk. So they're relatively straightforward, but in order to be a part of them, this is one of the things that the SEC puts on us, is we have to be an accredited investor. Now, I know that's a word that a lot of people hear. I would probably say that a good number of you are actually accredited investors. You may not know it. So we're going to go through the criteria. You can buy into these funds either as an individual or a company. As an individual, an accredited investor, what it has been for years is you have to make $200,000 a year, 300 if you're married, for the past 2 years. So it has to be a consistent, for the past 2 years, your income has to have been over 200,000 or 300 if you're married. They want to see a consistent pattern. Okay. Or you have to have over $1 million in assets, not including your primary residence. So let's say that you owned 4 or 5 rental properties and they were all worth $200,000 each. You're now an accredited investor, even if you don't make $200,000 a year. Okay. So that's for an individual. For a company, because companies can buy these securities too. So inside of a company, the company has to have $5 million in assets. So that's the first part. Or all of the partners in the company must be accredited investors. So that's an accredited investor. Now, the SEC just changed in, I think it was April of 2022. The SEC did change, make one change to this. August of 2020. The SEC made a change and said, if an investor can qualify as accredited based on measures of professional knowledge, experience, or certifications. So there's some specific criteria for it, but this is a new change that's happened. So what you can do is, let's say that you're an accountant. You would be considered to be an accredited investor just simply because you have the knowledge to be able to do this, because you have that. So if you have an accreditation, let's say that you're a financial advisor, and you have a securities license, you would become accredited because you have that certification. So based on experience, or if you've been a real estate investor for 30 years, you'd have the sophistication necessary to do that. So that's a change that happened recently, but it's sort of interesting that a lot of people may not think about it, but you're probably accredited. It's a pretty low barrier. So let's look at some examples. So let's say a couple. They make a combined income of $250,000 a year. Okay. So by that criteria, they don't make over 300, they're not accredited. But let's say they both have IRAs and both IRAs are over $1 million. They're now accredited. So it's either or, income requirement or number of assets. Okay. So let's say that we have another person who's making $100,000 in his job. Not accredited just by that, but let's say that he's got $700,000 in a retirement account and 3 rental properties that are worth a total of $400,000. Now he's accredited. So the reason for accreditation, I want to go into a little bit of this. We're going to get into weeds just for a second because I want to show why the SEC does this. You can start. We tend to focus here at Money School around funds that are based on real estate. So we want to stick in the real estate realm. Something we've done for years. We know it really well. A lot of us are realtors. We've been investors for a while. So it's our thing. We're really good at it, right? So we want to stick in our lane. But you can start a fund to start a business. So let's say you have some new type of tech. You have a tech startup, okay? And you want to pool your money into a fund to be able to fund that tech startup. You can do that. Say exactly the same kind of 506B, exactly the same kind of fund. But there's some risk involved because a lot of companies, when they get up and going, there's nothing to back up that. There's no security behind it. There's no real estate behind it. There's nothing to back it up. It's not secured by anything. So you could lose all of that money. And what the SEC wants to do is to make sure that if a fund like that were to go bad or you were to lose all your money in it, you wouldn't bankrupt yourself. So they want to make sure you have the assets enough assets to be able to recoup if an investment goes bad. So that's why the SEC wants to put that in there, or wants to do only accredited investors. So so that's generally the funds that we have or anything that we offer. Generally, we want accredited investors. All right. Now, a couple of caveats. There's 506B. I told you that only partners can talk about a 506B I can only give details of a 506B fund. So that's part of what the 506B is. Then the SEC came along and said, maybe do something a little different. We want to come up with what is called a 506C, as in cat. These can be publicly advertised. So I can go on Facebook and advertise that we are open. We're able to go through and accept folks from these. Okay, so that's something that was allowed. That is another type of fund. We generally don't do those funds. They open us up to a little bit more liability because now we're not doing it inside of our tribe. We're doing it to the public in general. We like to stick inside of our tribe and give you guys the advantage of all of these funds. Okay. So it is another type of fund. Yeah. So yeah, funds are something, they're a good stable source of income for you. Income is generally anywhere just kind of off the cuff, about 6 to 12%, depends on the type of investment that you're doing. There's different terms to it. So you put your money in for 12 months. At the end of that 12 months, we give back all the principal. You now have the ability to go back into another fund or into another investment. It's a nice way to kind of get in and out of them. Generally, they're within 1 to 3 years is about the term on these funds. Quick note of caution with the funds. If you do, let's say, invest for 18 months or a year and a half, and 10 months into that, you need to take your money out. You can take your money out. There's usually penalties for it. So just to put it out there, but generally it's the ones that we are doing are all backed by, are all secured by real estate. And yeah, they're a great way to kind of get your portfolio up and going and give you that solid foundation for your portfolio. So I want to take a second because I know that's a lot of information. We just kind of dumped a bunch of things on you. First thing I want to do is ask if there's any questions. Please put them into the Q&A, please. So I know funds are not one of those things that take us a whole lot of time to talk about. So I want to make sure that we're going to have more than enough time to answer all your questions. And so if you've got them, please put them into the Q&A, ask what you want. We're going to go into a couple of examples of funds that we have available right now and how to contact the folks that are involved with them. So I'm just going to go into kind of to see what we have available, what they look like. And the first one that I'm going to go into is a fund that I'm involved in. Chris and I and Greg Hurley are partners in a fund called Cashflow. So what Cashflow is based on, because each of these funds is, like we said, you can start a business with these. They can be based on real estate. They can be based on, and this one, it's loan notes. So what we have is a fund that's based on loan notes. The returns are between 6 to 10%, and the terms are between 1 year and 3 years. So there's different terms that you can get into. The higher the interest rate, the longer you're in, the higher the interest rate, generally what goes on with funds. So that's one thing that we can do. And the nice part about being backed up by loan notes is we're very, very conservative with our numbers as far as these funds are concerned. So the loan notes are backed up by real estate. They're backed up by real estate at 60% after repair value. So for those that might be kind of new with what ARV or new to the real estate world, what that means is that it's backed by a house that if we were to put it on the market after it's been repaired, we only lend at 60% of that. So let's say it's a $100,000 house. You can sell for $100,000 after it's done, or after it's all set and done, and we've done all of our renovations on it. So that's its fair market value. We will lend up to $60,000 on that property, period, for everything. So we like to leave ourselves some cushion room in there just in case something goes wrong on a deal. We just want to make sure that we've got extra meat on the bone in case we need to take action on it, or we have to take possession of it. Now, the nice part about this, we handle everything for you. We handle the loan notes. We handle all of the we handle the loan notes. We handle making sure we find the investors. We take care of if there is a foreclosure on it. We take care of all of that. These are definitely set it and forget it funds. There's another one that's open right now called Safari Fund. That one's open with Chris Root. It's based on mobile home parks, but similar concept. They're all the same kind of fund, kind of a nice base for it. So every fund's going to be a little bit different, but this current fund, the minimum is $15,000. And we wanted to keep this really, really low. And the reason we want to keep it very low for you is if you have, let's say, $15,000 left in a 401k or in an IRA and a self-directed IRA, and you can't really do a whole lot with $15,000 in SDIRA. So we wanted to create an asset, something for you that you could actually go and just put your money in, leave it in there for a year, 2 years, however long you think it is, however long you think it needs to be in there, and you can still keep that money moving. Because again, like I said, in a self-directed IRA or some of these self-directed 401k, solo K, whatever it is, if the money's not moving and it's just sitting there, your money's just sitting there. There's nothing else. There's nothing really that you can do with it. Okay. So that is the first one we have. Let me do this. I'm going to put into the thing here my email address. So if you have any questions on it, email me at that number, or you can text or call me at this number, the cell phone. If you are interested in getting into the Cashflow fund, that will be the first, that's the first thing that we're showing you today. Please let me know. I can go through the details of it for you. I can also go through some of the details on how it would fit into your portfolio. You can go from a self-directed IRA. If you are going from a Horizon Trust self-directed IRA, it's a little bit easier. I can help you fill out the paperwork for that. You don't have to go through an IRA. You can just do it from a savings account you have. You can fund these from just about any place you'd like. But let me know if you'd like to get on the phone and chat with me, and we'll definitely tell you a little bit more about them. So let's go to a couple of questions. Got a good one. So what is the minimum that you have to invest in each of your funds? Totally depends on the fund. So the next one I'm going to show you is 50. Is the minimum amount for it. The one that I have is 15. Each fund's going to be a little bit different. It's anywhere between, usually they float between 10,000 and 100,000 is the minimum amount to invest in those funds. But each fund has its own little, has its own special way of doing things. Each fund is sort of different, and each fund has a specific goal in mind. Yeah. Cool. So let's talk about another one here, and I'm going to share my screen because I'd like to show you this one. Oh, Mark, to answer your question, there should be a little view icon up at the top that'll allow you to maximize your screen. I'm done with the board though for a second. So yeah. All right, let me share my screen. We're going to go through the next one here. This is an amazing opportunity. You will find this over on the Private Money Club. I did this right. I'm on Chris's computer today, and everything's not in the same place I'm used to. Gotta get used to it. All right. So this one is Duck Fong's property that he has. So it's out in, let me make sure I got this right, New Mexico. It's a glamping, it's a 1,600, almost 1,700 acre glamping site. I had a brief chat with Duck this morning. He has 250,000 to go left in this. So he's almost, he has enough money to close it. So he's enough money to close the deal. The deal is moving forward. What we're doing right now is he wants to raise some money so that he can, for operational expenses at this point. So, and the last deal, we tried, something fell through, and I don't know exactly what it was. Something fell through, didn't quite work out. This one is going through. He has enough to close on it. We are going to move forward, and he's just using the money right now for operational capital to get up and going, because it's a huge property. I'll show you some pictures here. So I want to give you an idea. So here's the stream that goes through. There's about 2 miles of stream on this thing. This stream gets to up to 30 feet at one point. So it's not a stream, it's a proper river, really. It's huge. So beautiful, beautiful thing. There's some buildings involved. They've got, let's see, 3 buildings are currently on the site. There's heavy equipment and 5 horses involved with it as well. There's some more pictures. This is located on Private Money Club, so you can take a look at it. Now, if you look all the way out into the horizon, that's all his property. 1,700 acres. It's a huge property. It's a massive, massive property. It's one of the other buildings. The backhoe comes with it. He said last time I heard him talk about this, he said this is an old World War II era, if I'm right, schoolhouse on it. And they're gonna keep it on there, of course, make it so that it's not so it will be safe, but they're gonna leave that on the property so that way you have it. So what they're doing right now is they're looking for, if you invest between 50,000, which is the minimum, and 250,000, it's 12%. It's going to balloon at 2 to 3 years. Okay, so basically means they're doing a little bit of a different investment on this side of things. When they say it's a balloon payment, it amortizes over a longer period. So then after 2 or 3 years, you can reinvest or do what you like there. So it's one of the little bit of a different thing. We're also raising in what are called tranches. I kind of want to go into what tranches are and how they work. So let's say that I want to raise $3 million for a project, right? But I don't want to pay interest on all $3 million until I get construction up and going. So in this case, what he's doing is we're using the first round of funding. The first tranche of funding is just to purchase the property and operational costs to get him up and going. Then he's going to do another tranche or another part of funding to be able to then go, and he's going to build tiny houses on these. So when we do tranches, what we're doing is they say, okay, so I have $30 million I want to invest. I do it in 3 $10 million tranches because I don't want to pay interest on all 30 million while I'm not doing anything with the money. So I'm going to do my first 10 million, then I'm going to raise some more. I'm going to do a second tranche. So that's what he's doing. So it just gives you an idea about them. The next thing he's going to do, he told me this morning what he's going to do with his second tranche is about a year or two in the future. So he's going to buy tiny homes. You'll be able to buy a tiny home, about 100K is what they're looking at, fully furnished, ready to go. And then they're going to rent them on the glamping, they're going to rent them out for you. Think about it like turnkey Airbnb, right? So that's the second part of it. What he's going to do is before he does that, if you're an initial investor in this first tranche, he's going to give you first cut into it. So you get the ability to go out and, he's going to say, you guys, folks that are my investors, my current investors, do you want to go out and do this? Great. Let me let you have these before I open it up to the general public. So as far as the second parts, the tiny homes will be rented out, managed by his team. Investors will you guys will just get mailbox money. A lot of these are just mailbox money, and that's the nice part about it. Okay, so those are the two funds that we have right now. So, Ducks is still open. Mine's open as well. In the Cashflow fund, we are doing a maximum raise of 12 million. I know I think we've got about 2 right now. So that'll be probably closing in about, I want to say 6 months or so. Maybe less than that, depending on how quickly we can raise the money for it. But even though they might not be like a 20% return, which you might get on a flip, or they might be, there might be something out there that might be higher than this. If we all think the stock market, or actually we know the stock market's going to crash at some point in the near future, so might as well go around with real estate, make it something nice and a good solid base for your portfolio. And, it's less speculative than the stock market right now. So they're really, really good to have just a baseline level, something good, stable, backed by an asset, good foundation for your house. And then you can go out and do what you would like with crypto or whatever other, speculative investment that you want. So let me put into the chat here how to get a hold of Duck. So here we go. If you would like to get a hold of him, he's asked, let's get this right here, 5444. So you can text or call this number. That is his personal cell phone. He will get it. If you have any question about the funds, whatever you have any questions about it, anything else you'd like to know, if you'd like to get involved in any one of these 2 funds, please let us know. But yeah, absolutely. This is a great way to just standard mailbox money. No tenants, no termites, no property managers, no contractors. Put your money, let us do all the work for you, and we'll give you a certain percentage. We'll give you the percentage rates, again, in all of our investments, anywhere between 6 to 12%. We'll keep going from there. Cool. So yeah, if anyone has questions, please put it in the Q&A. If you have needing additional info, let me see. We've got one in here. Let's see. Hi, Andrew. A couple of my kids have recently gotten policies, but are not happy with the way they see them working. should we contact about them getting info on about their policies? So as far as the policies are concerned, just remember that when this is on infinite banking, so we're kind of changing topics here, but I just want to let people know. I don't want you to think this has anything to do with funds. As far as your infinite banking policies, it's always going to be a little bit different in the beginning, just the way they work. So what I would do is, if you're not quite happy with the performance, or you have some additional questions on it, talk to your mapping specialist. It's Jerome or Robbie. And they will get you additional information on exactly how they work and what to expect in those first few years. Again, with an infinite banking policy, it takes about depending on how the policy is, depending on how it's structured, anywhere between 1 to 3 years. It can take to maybe as long as 4. It can take to get to that break-even point. So at first, they don't. You won't get $1 out for every dollar in the first couple of years, but they do get better. They're a long-term game. They're not a short-term game. Awesome. Anyone else have questions on, I know we covered a lot of material here. We covered our funds, what they are, what a 506B and C funds. You'll hear Chris refer to them as Reg D funds, the same thing. They're exactly the same thing, or SEC registered funds. The same thing. So syndications also come under this. Syndications are a little bit different. You heard Chris Bizub talk about syndications a few month or so ago, where syndication is just we all go in to buy one property. You get some equity in syndications, but you can also lose money on a syndication too. So, but they're all part of a good solid portfolio. And again, with a portfolio, it's nice to have kind of that base layer first, get a good foundation for it. And these can be really, really good for that. And then build on and do other fun stuff. Like if the stock market goes down, buy low, sell high, or I should say when the stock market goes down, or if you wanted to get into crypto, or if you wanted to get into something a little bit more speculative or a little bit more volatile, these can at least make sure that if you do lose money on, let's say the stock market, or let's say on crypto, because hey, things happen, especially if you're self-directing something, things might happen. Having this as sort of a base for you is much more stable, and will give you that, will give you the stability you need to be able to grow your account, even if something goes wrong, even if you make a mistake. Hey, it happens. Mistake is another name for learn. Awesome. So yeah, we're talking about when we talk about funds, there's not really, they're pretty straightforward. A lot of people haven't heard of them. That's one of the things I tend to find with the Money Mover team is that we explain how they worked. And so we figured that since Snaggy was going to be out today and Chris is going to be out today, that we talk a little bit about these funds and how they can work into your portfolio. So please let me know if you have any questions about it. Chestnut at Capflow Fund. There's my phone number. That's for Capflow. And then you got Duck Visa as well. Got a couple of questions here. PMC has opportunity to acquire. Okay. PMC has opportunities that do not require fund criteria. Yes, they do. So I think if I'm reading that right, Mark, what you're saying is that they have opportunities that don't require you to be an accredited investor. Yes, correct. They do. So yes, there are many opportunities up on PMC, but we're going to start putting more funds up on PMC again for those folks that may have like 10,000, 15,000 left over in an IRA, or smaller amounts of money that they want to put in, or if they want to say, I don't want to be involved in real estate at all. I just want it to have that base level of real estate. I just want to have base level of real estate, basically, just enough that I get a good base going on, and that's it. So yeah, that'd be a good one for you. Not everything on PMC requires not all of them require accreditation. Cool. Let's see. Joshua says, can you explain how paying back your IBC policy loan, how it benefits you, what is affected when you pay yourself back? All right, Joshua, it is always a very good idea to at least pay back your interest in an IBC loan. At least pay back the interest every year. If you are paying back a lot of credit card debt, we may tell you not to, but generally our standard advice, unless there's a very compelling reason not to, is at least pay back the interest every year. What you're doing when you're paying that back again. So on most IBC policies, you get about, you'll earn 6%, which is the dividends and interest, usually 5-6%. On your cash value, you pay 5%, so you're netting 1% on all of this. If you pay the loans back, you'll earn a little bit more on them. We're not too concerned about the return on them. It's just the fact that I can still earn 1% while borrowing money. So the concept's a little bit different. That's the benefit of paying it back. If you pay back only your interest, or if you don't pay back only your interest, that interest is rolled into next year's cash value and reduces it. So what'll happen is you'll end up having less cash value available next year. If I'm paying off, a whole bunch of 29% interest rate credit cards, that's going to be different. I'm not really going to worry too much about, a little bit of interest being rolled into next year. But long-term investments, long-term strategies, it's always good to at least pay that off. So what you do is you pay off the interest every year with the money that you're recapturing. So the money that you were paying the credit card companies, you're now paying back to your segregated bank account. What you'll do is you'll use that money to pay off your interest every year. So that's the short version of kind of how that works. But yeah, that's the difference between paying it off, not paying it off, and the benefits and drawbacks to those different strategies. Yeah.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.